Hi, I'm Gary Stone, Senior Portfolio Manager for First National Wealth Management. 2025 highlighted how impactful international exposure can be to the performance of a diversified portfolio. The MSCI All Country World ex-US Index was up over 30% compared to the S&P, an index of 500 domestic stocks that by comparison was up 16%. This was the best performance for international stocks in almost 15 years. Is there reason to believe that international equities will continue to perform well in 2026, perhaps outperforming the S&P? Yes, for the following reasons. International equities are still less expensive than US equities based on current price-to-earnings ratios. The S&P trades at valuations close to 22 times forward earnings, while the MSCI EAFE trades closer to 15 times forward earnings. In other words, international stocks still trade at a discount to US stocks after outperforming the US market in 2025. The US dollar declined in value in 2025, more than 9%, the worst performance since 2017. International equities tend to benefit from weakness in the US dollar, as gains in foreign currencies versus the weakening dollar can translate into profits for non-dollar denominated assets. It's difficult to predict if the dollar will continue to weaken in 2026, favoring the international equities. But as domestic, political, and economic uncertainty persists, the possibility of a continued flight from dollar-denominated assets is certainly plausible. International exposure can dampen the volatility in a portfolio while providing opportunity for growth. Emerging market economies like South Korea, India, and China may at times grow at a faster rate than the US economy, as might developed Europe. A dangerous portfolio is one in which all assets move in the same direction. The US market and foreign markets often move in different directions. Owning both lessens the risk to the total portfolio. Another benefit to international investing is portfolio diversification. 35% of the S&P 500 is dominated by 7 multi-trillion-dollar technology companies. Foreign markets are less reliant on this monopoly and can provide investors with exposure to different sectors of the economy. A final thought: the US represents approximately 25% of the world's GDP, a measure of economic growth. That means that 75% of the world's potential for growth exists outside of the US, a compelling reason not to ignore international investments.